Welcome back to Vol Studies. This is Chapter 10, Introduction to Spreading. Now, Natenberg reminds us in the beginning of the chapter that you might be more familiar with two types of trading that are not spreading. The most obvious one to me is directional trading. Most of us probably do this on a regular basis. And the other is scalping, which market makers do all the time, although it's a little bit different in terms of options than it is with an underlying asset like futures. But for the most part, scalping is probably not something that we're able to do very effectively in our own personal trading accounts. Spreading is going to be a much more effective way to have long-term success as an options trader. It's also fundamental to the business of market making, as you'll see through some of the stories and anecdotes in the book itself. We're going to focus on option spreads because, after all, this is an options course. What is a spread? Generally speaking, a spread is a strategy that involves taking opposing positions in different but related instruments. This is important. Spreads generally involve offsetting risk. In fact, when you make a trade where the two legs compound risk instead of offset it, it's literally called a stupid and not a spread. You can imagine yourself why that is. For the most part, spreads consist of positions that move in the opposite direction with respect to changes in market conditions. And as you'll see going forward, options are unique in that they allow you to tailor spreads to any particular risk, not just directional exposure. Profitable spreading strategies are based on the assumption that position values will change at different rates. If you have a spread where the two legs offset each other perfectly and strictly, well then you have a perfect hedge, not really a spread, and you should expect no P&L from this, but your brokers will be very happy. Now, just like we mentioned before, we're going to focus on option spreads because, after all, this is an options course. Option spreads are not limited to delta or the underlying asset itself. While stocks and futures generally allow you to make bets on direction, options give you a whole lot of other dimensions to work with. For example, if you think the market might be slow for the next, say, 3 weeks, but get busier over time, or there might be macro risks or variables that cause volatility or the perception of volatility to pick up, you might want to trade a calendar spread. You might not even need to be right on direction at all, but if you buy a longer dated option and sell a shorter dated option against it, you make money whether the stock goes up or down, as long as your view on movement is generally correct. If the stock sits still for the most part over these next 3 weeks, your short leg will not realize. Another way of saying that is that the gamma payoff will not exceed the theta payoff, and as the seller of the option, you'll make money. On the flip side, if the perception of implied volatility goes up despite movement being contained in the near term, you'll make money on vega. And again, all this is irrespective of the underlying direction itself. It's just a bet on movement. Additionally, you can focus on moments on the distribution. Fancy way of saying skew or kurtosis. As you know, puts are generally more expensive than calls in the index. Not always true for single names, but generally true for the index. Some typical spreads here, for example, risk reversals. Selling a put and buying a call attempts to harvest the skew premium, which is another fancy way of saying that if the market goes down, you generally don't expect it to be as volatile as the premiums imply. Conversely, if the market goes up, you may expect that it will be a faster move than the call premiums imply. Selling a risk reversal generally pays you theta and gives you a little bit of long gamma for your trouble, but the danger is if you're wrong. Kurtosis right below is just a fancy way of saying wings, and a typical trade here might involve a backspread or a ratio. For example, if you believe the market might gap higher and vol might go higher with it, we call this spot up, vol up dynamics in the index, you might structure a trade that's short a 25 or 35 delta call, but long 2 or 3 5 delta calls against it. With a position like this, if the market were to rally quickly, you may lose a little bit of money on delta initially, but as the options reprice, if volatility goes bid or increases, you will net make money. There are endless ways to do this. And as you get more advanced and more experienced, you'll focus more on these conditionals, speed, and Vanna, and Volga. These are the Greeks that are fundamentally embedded in the types of trades we just talked about with risk reversals and ratios. You can express views as precisely as you wish. Spreads can be dynamic or spreads can be static. When we talk about market making, almost everything is dynamic. Things are hedged so frequently as to be considered continuous. When it comes to customer spreads or institutional spreads, and of course our own spreads, they're usually static or much closer to static with less frequent adjustments. If you're part of our VIP mentorship, you're very familiar with some of these. The JP Morgan quarterly put spread collar is perhaps the most obvious example of a static spread. It's literally set and forget, initiated one time and carried all the way until expiration. Same goes for the Global X ETF buy right, the call option that's sold every OPEX Friday and carried all the way through until the next cycle. Now, it's not totally uncommon to encounter spreads that are adjusted on a less frequent basis for either rolling or defending. For example, a common one is the go around. This is a buy right spread with a hedge that's adjusted when the market gets near it or when time passes in order for the fund to target a specific maturity for their short. Additionally, it's common to see near-dated put spread sellers that will roll their trade down and out when threatened. And again, while virtually all market-making books are dynamically hedged almost continuously, for the most part, expect that our trades will fall somewhere between static and infrequent dynamic. Why spread at all? It's a good question. Hopefully you probably already have some answers of your own, but in case you don't yet, there are a number of reasons which make spreading attractive not only for us, but for a market maker as well. Risk reduction is attractive to everyone, market makers included. While legging into positions may be attractive if you believe you have edge in your entry, it's almost universally true that when you package things together, you'll get better quotes. And what about us? Why do we spread? Well, there are a number of reasons, one of which is mispriced options. You'll notice a little star here. That star is to emphasize the point that this is perception. Remember, options are model-based. Your assumptions or your inputs into those models might be different than someone else's, and to the extent that you're correct, you might have mispricing to take advantage of. The fact is, it's unlikely that we'll find pure arbitrage. Sorry to burst any bubbles here. It's just true. But don't worry, you don't need pure arbitrage to make money here. To the extent that your view on the market is correct, you can make more money with spreads than you could with outrights alone. For example, let's say you have an important Fed meeting coming up and you believe the market's underpricing the response to the release. You buy a calendar spread in which your long option includes the event and your short option expires right before the event, ideally. If you're right about one of two things, either the market being relatively static leading into the event, or the event being more volatile than predicted, generally speaking, you'll make money. Like we talked about before, spreads do allow you to go beyond directional trading, although they can, in fact, enhance your directional trading as well. Vertical spreads allow you to bet more effectively on ranges and levels, and we'll talk a lot more about these in the chapters coming up. And I want to introduce you to this concept here because we'll return to it frequently, not only in this course, but also if you're a part of any other Vol Signals mentorship or course. This is something not to forget. When you're structuring your spreads, your long options should be those that you believe the market should go through. And your short options should be those that you expect the market to go to and generally stop. In chapters to follow, we'll talk a little bit about how you select those strikes and optimally how you map different views to different spreads. And last but not least, just like market makers want to control and limit their risk, you should want to control and limit your risk. In the end, your account will live longer and grow bigger if you are tactical with how you hedge your risk. One basic heuristic that I tend to follow myself, I prefer to buy outrights and sell spreads. Why? If I sell options, I'm short some kind of risk, but I may not want uncapped risk, so I use spreads instead. However, if instead I want directional exposure, or I do want long volatility, I do want long gamma, I may not actually want to sell away my convexity by spreading. Of course, there are reasons for both, and we'll talk about these as we move through the chapters that follow. Nothing is perfect, but spreading is critical to mastering options trading for the long term. Next up, we'll talk about volatility spreads and expose you to some of these concepts in the real world. See you then.